Just checking where Brent is, just above 68.
Yes, we're live now. Thank you.
Oh,
All the best.
okay. Thank you, Madeline. Listen, do not adjust your TV sets. I am going to be your guest moderator today. Shout out to Paul Hicken. I stole that line from him the last time that he guest moderated. So it is June 25th, and Brent is recovering off of yesterday's lows to about $68. And after a crazy couple of weeks, it's almost like there has been no escalation from Israel, Iran, and the United States, and no attacks because we're trading approximately the same place that we were before the escalation. So, is the market sending signals? Are we comfortable with supply when we're looking at the demand side of the market? Is the Strait of Hormuz, is that a real concern or is there nothing to see? There's big, big, big questions on the oil markets and even bigger questions on the financial markets. Unfortunately, we have a great lineup today, and we're going to dive into each one of these. So first off, I wanted to welcome Sarah Akbar, and she is the CEO of OilServe in Kuwait. And Sarah, I wanted to ask you about OPEC Plus policy. It has succeeded so far, at least objectively speaking, it's succeeded so far. But will it change or will it get more difficult for OPEC Plus to make the decisions for the second half of the year, given the intense volatility that we've just had in the geopolitical spectrum over the last 2 weeks? We were just talking about it before we went live. So, what's in your crystal ball? What do you see for OPEC Plus for the second half of the year?
Well, good morning, Brian, and happy to be back on this nice podcast. So I think it's on the contrary. I think things are becoming much easier for OPEC Plus, genuinely, because the biggest competition in the past was the U.S. oil and gas shale, and since Trump came and he wants to increase production and keep drilling, but this resulted in something like, dropping down on the rig count. Oil decline in the U.S. is obvious now. You can see it. It's almost 600,000 barrels a year. You lose a day per year that you are having without the extra drilling that is needed. So if this trend continues, OPEC has no problem whatsoever to make any kind of decisions and increase and utilizing the capacity and so on. So I think, the strategy that OPEC Plus has had so far has really worked well, and they will just continue, but things are really getting better for them.
Okay. And a quick follow-up question before we move along is do you think the Gulf infrastructure is vulnerable to the turmoil or the escalation that we've just seen? Do you think the Gulf is vulnerable, or do you feel like there's pretty good defenses in measure? What's your take on that?
Well, you see, we have been through extremely tough times so far. Not one time, not two times, many, many times. I remember in the 80s when our ships, the Kuwaiti ships, we had to change flags because of they were hitting the oil. And we've gone through so much, and the oil kept flowing. There was never a moment in time that there was, that the Gulf was not able to sustain production and to provide the world with the energy security they need. So, what changed? The common factor here is that every single country in the region has the common interest of keeping production up. And,
Hmm.
and this is a very solid base economic factor. And that's why, under all circumstances, things will continue. And that's why, at this point in time, we see huge investments going into oil and gas. Recently, ADNOC is buying Santos. They are investing 5 billion in their own infrastructure. Saudi is doing so much in Saudi itself and abroad. They are investing heavily in developing gas in Saudi. Iraq is going, boosting production like hell with every single field they have. Same with Kuwait, same with everybody. So as long as this direction continues, an investment in the infrastructure and putting more investment to sustain and grow production, I don't think anyone. And look, the war is this small battle between. I don't call it a war. It's a battle between Israel and Iran. Stopped now, but I don't believe this is the end of it. And there might be other things that will come into the future. God knows. But what was interesting, the comment from Mr. Trump saying now Iran can sell oil to China. I really don't know what did he mean by that. But if it is like, oh, we are going to remove the sanctions so that you can sell oil, or we are trying to bring you back into the, to the international, something there. Again, we really don't know, but things look much better now at this point in time for the oil and gas than it used to look like a month ago.
Yep. No, that's fantastic. Sarah, thank you for bringing that perspective from the Middle East. I really appreciate that. Vandana Hari, who is founder and CEO of Vanda Insights. Now, you and I have been on before, and I've listened to your insight and expertise, and it reaches into so many different aspects of the energy industry. I'm going to ask a little bit of a different question. Should China be expecting Trump to now switch focus away from military and back to a trade war, given all the chess pieces that have switched around? So, Vandana, thank you so much for joining today.
Thank you very much, Brian, for that kind introduction, and good day to everyone. So a great, you've offered me a nice segue from where Sarah left off. And just very quickly, I really appreciate Sarah's comments there about the common interest in the region trumping everything else. So there will be regional rivalries. I don't think that'll end anytime soon, but that's a wonderful comment. I'm totally on board with that. So let's talk about China and the US, and also something that Sarah left off on, which is like there was a bit of a kerfuffle in the market. What did Trump mean by his social media post? China can now continue buying oil from Iran. My interpretation of that is, of course, you can interpret it. It was a little bit vague, so you can interpret it in different directions. I think it was basically Trump saying that since the tensions were down, the threat of the blockade of Strait of Hormuz had been eliminated. Now China, without having to worry about getting oil out of the Middle East, and including Iran, can now do so. I do not think he was alluding to the sanctions on Iran being lifted. And this now in turn ties to your original question. Where do we see Trump's attention now going? So I think it will remain on the Middle East for a while, because we have seen ceasefires broken in the past all the time. It happens. I think also this is a ceasefire. It's a pause. It's not necessarily peace. So what I mean by that is that whole issue of Iran's nuclear ambitions is still outstanding. As we were speaking offline, Brian, just before we started here, there's some 409 kilograms of enriched uranium in Iran, which appears to be missing, or in the sense that the West or the US doesn't know where it is. So I think also what happens to the stalled US-Iran nuclear negotiations? How soon do they get back on track? And I feel that's the big picture. Oil market, notoriously short-sighted, is not looking at that. But I feel that, we may be kept on our toes. So this may be a temporary pause. But yes, in the big picture, I think as long as the dust remains settled on this Israel-Iran conflict, which I think probably we have bought, or Trump has bought the world a little bit of peace and relief for a while. I think the attention is indeed for the oil market shifting back to the macroeconomic picture. What happens to the trade deals? What happens to the great, big, beautiful, wonderful, fantastic bill? I don't know if I got all the descriptors in there. And what the Fed does. So we heard the Fed Chair Jerome Powell being grilled yesterday by the Congress. Obviously, there's a great deal of pressure on him to start dropping rates again, especially given the divergence with ECB, which has been easing rates at a rapid clip. So yeah, I do see the market attention shifting to the macroeconomic picture.
Okay. And that makes sense. And it kind of tracks because this is probably before the escalation. This is probably the trajectory that oil was on, is kind of in a bearish setup or a bearish cycle. But that's kind of an interesting juxtaposition to our next guest, our next speaker, Peter McGuire, who is going to have amazing insight from Australia, who always gives me a complex on what I'm wearing because he's such a sharp dressed person. So Peter McGuire, who is CEO of trading.com, should we expect oil to catch up to other asset classes in the second half of 2025? What do you think from your corner of the world, Peter?
Well, Brian, lovely to join you, and to my fellow panelists, it's great to share a screen with you. Greetings from Sydney. I tell you what, the first half, we're 6 months from Christmas. We're 6 months to Christmas. It's been an enormous, when you're thinking this first half of the year, what we've seen from an inauguration, and then we've just been battled through with Israel versus Iran, and then everything in between. You've got equity markets nearly at all-time highs, Brian. You've got President Trump saying he wants probably between 100 and 200 basis points of cuts. And he's aggressive, and I'll tell you what, he's really going to pressure, I think, in the second half, Jay Powell. He says he's going to be independent, but I'll tell you what, I think the pressure is going to be absolutely on his throat. And it'll be a little bit like Jack Welch, I'd say, in the old days, Neutron Jack. That's what I think President Trump's going to be second half. Tariffs, yep, all about introducing and getting some more or less common ground within in Q3, that they're fully engaged by Q4. I would think that from a timeline perspective, as far as where Jay Powell, the 10 years running at 4.3, you've got an equity market really on fire. Asia was very, very strong yesterday. Some of those markets were up 2, 3, 4%. So that was overall good theme coming through. We all saw what happened with gold. I think big margin calls would have been wiped out a lot of people who were long in the futures. So probably, and US dollar index coming under massive pressure. It's now under 98 in a 97 handle, I think about 97.6 or 97.8. Well down from those highs of 99.40, only a couple of, I think that was Monday. So it give you some indication there's a softness, there's going to be more pressure, I think, to US dollar softness. Currency trades have been good. Euro, yen, and pound have been great. And where we sit here, Brian, I think, as I said, the second half's going to be electric. And you thought the first half was good. I reckon the second half's going to make it even more exciting.
That's actually what Vanda and I were talking about before. Is right now, today, it's calm, and that actually is a little concerning because it means it's something else brewing, because it's been a little crazy. But Sarah, let's get back to your view on, and again, I'm going to target OPEC Plus because I think there's a big variable, and there's still barrels offline by different numbers. You can count it a ton of different ways, and my estimate is probably a million and a half, or somewhere between 1.5 million to 2. Most of it being most of that cut being in Saudi Arabia, with some of the turmoil that we've had in Iran, when we look at Iran, Iran grew from 1.8 million barrels a day up to 3.5 million barrels a day under sanction. So when we get into sanctions, well, what does that really mean? It's more an economic thing than the oil still flows. To your point, oil still finds a way to flow. What do you think Saudi Arabia's position, given that they're bearing the brunt of the cut right now, or self-imposed? What do you think they're positioning, thinking? How do you think they're going to play this scenario out? And I say Saudi Arabia, it's really an OPEC plus, but I'm kind of pointing at Saudi Arabia, but just because that's where most of the barrels are cut. So what's your viewpoint there?
Well, okay. So let me address one point you mentioned about Iran production growth. I think people keep forgetting Iran is all about gas more than oil.
Okay.
So most of
With the
fields
Pars field?
not only the Pars field, Iran has enormous amount of gas that has not been even touched. I believe today they must be the biggest reserve in the world of gas just sits there, which has not even been developed yet.
Mm.
In the Gulf, offshore, onshore, they have plenty of gas, far more bigger reserves than oil.
Okay.
In reality, many of the oil fields that they are producing today needs a lot of rehabilitation work for it to achieve its potential. But even if they do all of that, they cannot grow their production in a large way to compete with Saudi or even with Iraq.
Okay.
Simply because they've been producing them for a long time. They're old fields. They are really good technically in developing their fields and to trying to maintain their production. But the biggest changing factor for Iran will be gas development if they are ever out of sanctions, because they really need a lot of investments into the gas sector in order to achieve their potential.
Okay.
Now, coming back to the cut in OPEC and the production. So there are few countries in OPEC that actually have that surplus. Number one is Saudi, as you mentioned. But then the people who are dying to increase production are the Iraqis and the UAE. Those are the ones that have real serious closed capacity that they are in desperate need for kind of unleashing some of that. So there will be some competition on the amount that they can grab from whatever increase they will have. I think if OPEC can add another 1 million to their quota, they will be doing extremely well. Everybody will be happy because Saudi can add, UAE can add, Kuwait can add, Iraq can add some of that production. And that actually matches to a good level the growth in the market under the current circumstances. I think the estimated growth annually is something like from 1 to 1.5 million, taking into consideration all the decline, the natural decline that's occurring. So if they can grab 1 million going forward into this next half of the year, that will satisfy a lot of the requests that they have outstanding from the various countries. That will be the best outcome for all.
Yeah, that makes a tremendous amount of sense, and really kind of loops back to kind of a balancing act between that supply and the demand side of the market. Which Vanda, now let's actually shift to some of the Asian economies and want to get into your viewpoint, because you have such an extensive viewpoint, especially from Singapore and into the Asian markets. And when we faced this de-escalation or risk off, and oil went from 70, well, I'm using WTI, but 78 down to 65, down $13 to 10 to $13. Most of the questions were really around demand, and now that we're 6 months into the year, 5 months worth of data, what do you think as far as the first 5 months of the year on Asian economies, and what do you think for the second half? Is there hope for demand growth? Because I'm not sure we've seen too much of that so far this year.
Yeah, so the big picture does remain that Asia remains the driver of global oil demand growth. I honestly do not see demand. So if you look at the other two major consuming centers, US and Western Europe, um, I would say probably my base case would be a plateauing demand for the US, and the best case for Europe is just a marginal decline year on year. So you can pretty much rule out those two major consuming regions to add anything to global oil demand growth, which pretty much leaves the spotlight on on Asia and within that China. So as far as China is concerned, look, even before these tariff wars started, the story of China coming out of the doldrums of COVID was, a much longer, stricter lockdowns than the rest of the world, which had inflicted a considerable harm on the economy than some of the other major emerging markets, which were able to recover, let's say, a little bit more easily. So that was one. The long COVID shutdowns did not help the Chinese economy. The structural changes that were happening, and big ones within China, even before COVID, have carried on. So that's been they added a double whammy. So what I mean by structural changes is the entire pivoting of the economy, like what drives the economic growth in China. So it has been, even before COVID, the country had been moving in a very slow, lumberous manner from export and industrial production driven to domestic consumption. Now, this is a sort of a once in a generation or two generations kind of shift, which is not going to inject the same kind of economic momentum very quickly. You can't just steer the ship in the other direction and start racing. So that, and then the third sort of aspect here with regard to Chinese oil demand is the other structural change, which is that it is becoming a less oil intensive economic growth, which is a factor of moving away from export and factory driven growth to more consumption and services, but also because of a very rapid pace of electrification, very rapid pace of shift to LNG in trucks and buses and so on. So here, we're talking of like sort of generational shifts, major pivots that are happening in China, some of them amplified, or the struggle of making that change amplified by the longer, stricter COVID lockdowns. So all in, I don't see Chinese economic and oil demand growth ever returning to the high single digits. Even if it's 4 or 5%, I think that's probably a remote case for me. I feel, Brian, that the new normal for Chinese oil demand growth is probably going to settle somewhere between 1 and 2% year on year.
Wow. Okay.
So
That's a shift.
Absolutely, absolutely. So that is my assumption for China for this year. I think so far what we have seen in the first 5 months or so in terms of their crude imports are actually a very good proxy and a great one to keep an eye on. But at the same time, also keep in mind that all the crude being imported is not being refined and not being consumed as fuel in China. So we have seen over the first 5 months of this year, China has stockpiled an estimated 1 million barrels, almost a little bit less than that, but 1 million barrels per day of oil, which is the same story that we saw in 2024 and to a large extent in 23 as well. So China has been buying this oil, but while the crude import rates are going down, also discounted further because they have been salting away a lot of oil. Now, if we zoom out into Asia as a whole, Indian demand growth is doing relatively well. Indian economy came out of COVID with a much better recovery momentum than China's, of course. But also keep in mind that Indian oil demand is less than a third of China. So even if India grows at about So China consumes about 16 million barrels per day. India consumes about 5 million barrels per day. So even if India grows at what I would call a sort of a base case scenario of about 4% growth, it's adding about 200,000 barrels per day. In absolute terms, that's about the same as what China is adding as well. There isn't a readily available China anywhere else in the world, I think, that could drive oil demand growth the way we saw it through the 90s and the first decade of the century.
Okay, fantastic. Thank you so much. So now we're going to go to the survey question. So this is a true or false or agree, disagree. The oil market can definitely rule out any possibility of Iran closing the Strait of Hormuz. Do you agree with that statement or disagree, or that's there is no maybe. So you either agree with it or you disagree. So I'll be curious to see the answers to that. So listen, let's move on to Peter McGuire. So Peter, we have had a lot of asset classes, a lot of stock markets that are setting new highs. Conversely, crude oil went down about $15 this year. Will that distortion between equities and crude ever resolve to where either stocks come down or crude comes up? Is there going to be a convergence between equities and energy commodities, specifically crude oil? What's your take on that?
I think, Brian, over the next, it's hard to go out more than, say, 3 months because there are so many moving parts, because we've got tariffs to be introduced. We've got the impact that that could have to countries anywhere in the world. We understand rate policy and what's happening, as you said, Eurozone, I think it's nearly 10 cuts they've had versus the US. You're talking growth across the China, the fabric of Asia. And if you think about what I believe the storyline is with the linkages back to Saudi and cutting or increasing production and looking to see softer prices, structural weakness as far as crude prices. I feel as though the stock markets will continue to move, may not be ratcheting up at 5% or 6% by end of year, but I think they'll be up a few percent by end of year from where they currently are. So they'll be taking those all-time highs out. Predominantly the US I'm referring to, cheaper rates, and say bond yields I think will come down, cheap but lower dollar, and in turn I think lower energy prices. I'm not sure whether they'll hit in the 40s, but I think the 50s are going to be the new home for WTI and Brent, and I think there's going to be a glut in the market as far as capacity going to probably 3 months time.
Yeah, and I do think you're right. And actually, 2 days before U.S. Bombed an Iranian nuclear sites, I actually was on a podcast with Paul Hicken at Petroleum Economist, and and I got quoted as saying, "I see oil going to $50," and then 2 days later, I was like, "Oops, okay, well that didn't happen, but maybe it happens now. I don't know. So we'll see." Well, let's shift over to Sarah. And Sarah, I'm actually going to give you the last word. Now, I kind of want to explore this thought that you planted as far as the gas reserves in Iran. One of the things that Vandana was talking about is kind of the shifting of energy consumption and what that looks like in the new style. Are we shifting away from crude oil and maybe more to electricity, more to needing gas for electricity, which means those gas reserves in Iran become much, much more valuable? Do you think with that extensive gas reserves, obviously there's a partnership with Qatar in the Pars field, is there a way for you've got to abstract the current situation and get into the future mind, but is there a way for Iran to really extract that and then put that into LNG to find markets, or are there pipelines that they could shift into that would serve other markets? Is there a way to bring that gas to market from your viewpoint, your part of the world? Oh, you're on mute, Sarah.
So Brian, if I was a conspiracy theorist, what I would say is the only reason why Iran is under sanction for the last 30 years is because they have gas reserves. And there are other people who would love to sell their gas to the market. And it's in their best interest to keep Iran out. Now, I don't see the Iranian gas coming to the market anytime soon because there is plenty of gas in the US, and there is like 11 LNG projects in different parts of the US that are being either constructed or actually in operation that wants to sell cheap US gas to the market. So why would anyone in his right mind allow Iran to develop any kind of gas to the market? And like I said, the basis where I come from is in the 80s, they did something called the Persian carpet. This is a seismic survey of the whole Persian Gulf, the Iranian side, the Arab Gulf, the Persian side. And in that survey, you could see huge structures of gas all over, including one underneath the Bushehr power plant, the nuclear plant. So in my mind, I was thinking, why would anyone in his right mind put a nuclear plant on a gas field?
Right.
So this is the amount of gas they have on the other side. And sometime in the future, that gas will become, there will be economic viability for people to come and help develop all of that gas into the market. But that is not going to happen anytime soon. And I think until there is a real reconciliation in the relationships between Iran and the rest of the world and the US mainly, that gas is not going to see the market.
Okay, great. Well, listen, thank you so much, Sarah. Really appreciate you joining. Vandana, thank you so much. Peter, thank you for making me feel even more insecure today. And it looks like the survey is in. 77% say they agree, which means the oil market can definitely rule out the possibility of Iran closing the Strait of Hormuz. So listen, thank you so much. I hope you all have a wonderful day, and thanks again, and I hope to see you all soon.
Thank you, Brian. Cheers, Vandana. Bye, Sarah.
Yes, bye.